As 2026 dawned, Warren Buffett, the Oracle of Omaha, quietly stepped down as CEO of Berkshire Hathaway. His journey from a numbers-obsessed boy to the architect of a global business empire inspired millions. Buffett was more than a CEO. He was a teacher, philanthropist, and a beacon of common-sense wisdom. He transformed a struggling textile firm into a fortress of value, guided by simple, powerful principles. Invest in what you understand, seek lasting advantages, and buy at a fair price. His favorite holding period? Forever. This long-term mindset helped Berkshire weather storms and grow for decades. His annual letters became must-reads, distilling complex finance into wit and wisdom for all. Even in his final months, Buffett stayed true to his disciplined approach. No grand gestures, just patient, principled action. Today, as he remains chairman, a new era begins, defined not by a final splashy deal, but by the quiet confidence of a leader who built to last. The story of his last big hunt, and why it remained unfinished, offers timeless lessons in patience, discipline, and letting go. Warren Buffett was famous for his elephant acquisitions, massive deals that could move Berkshire's needle. In his final months, he was ready for one last big buy, with $100 billion at his disposal. But the right target never appeared. The reason? Price. Buffett refused to overpay, no matter the pressure. In 2025, most large companies were simply too expensive. He wouldn't compromise his principles for a headline-grabbing finale. For Buffett, the risk of overpaying outweighed the urge to act. Some were frustrated by his patience, but he saw most opportunities as peanuts for Berkshire's scale. He needed a transformative deal, not just any deal. The hunt ended quietly, a testament to his discipline. Sometimes the smartest move is to do nothing at all. Buffett's final act as CEO was a lesson in restraint over spectacle. As Buffett's last year unfolded, Berkshire's cash pile soared to a staggering $381.6 billion. This reserve was both a symbol of strength and a fortress against crisis. The cash came from profits, dividends, and major stock sales. It gave Berkshire immense flexibility, ready to strike if the right opportunity appeared. But this mountain of cash was also a burden. For an investment company, cash is raw material meant to be put to work. Sitting idle, it loses value to inflation and drags on performance. The challenge. Berkshire was generating cash faster than Buffett could invest it wisely. He refused to chase overpriced assets, but knew holding so much cash wasn't ideal. This tension between patience and pressure defined his final year. It's a rare problem. Too much success, not enough opportunity. The dilemma set the stage for the challenge his successor would inherit. Buffett always insisted on liquidity for safety, but warned that too much cash is a poor long-term strategy. He likened cash to oxygen, essential, but having excess doesn't help you breathe better. In 2025, Berkshire's cash sat mostly in low-yield treasury bills. Safe, but barely beating inflation. In contrast, owning great businesses generates real returns over time. A dollar invested in a productive company works. A dollar in cash rests and erodes. A giant cash pile can also signal a lack of opportunities, or that the company has grown too big for meaningful deals. Buffett faced this exact problem. Few potential acquisitions were large and cheap enough to matter. His discipline kept him from bad investments, but holding cash was also suboptimal. It was a classic rock-and-a-hard-place scenario. The growing cash pile wasn't about glory, it was a business problem. Buffett knew Berkshire's future depended on turning idle cash into productive assets. The search for value, not just size, remained his guiding principle. 2025 wasn't idle for Buffett. He made bold moves in Berkshire's stock portfolio. Most notably, he sold large portions of Apple and Bank of America, longtime cornerstones. Apple, once his favorite business, had soared in price. Buffett trimmed the position, not out of doubt, but discipline. The same logic applied to Bank of America, selling high, waiting for better opportunities. These sales swelled Berkshire's cash reserves, turning paper gains into real cash. Buffett was a seller in a seller's market, clearing the decks for the next big chance. His philosophy discipline means knowing when to sell, not just when to buy. These moves were calculated, not panicked. A master capital allocator preparing for what's next. While the elephants stayed hidden, Buffett did make a significant move in 2025. Berkshire acquired OxyChem, Occidental Petroleum's chemical division, for $9.7 billion. It wasn't the blockbuster he hoped for, but it was classic Buffett, a solid, understandable business with predictable cash flow. Buffett knew Oxy well, having invested in the company before. The deal fit Berkshire's style. Real assets, real earnings, no hype. Though small compared to Berkshire's cash, it was a productive use of capital. The OxyChem purchase showed Buffett sticking to his playbook, even late in his career. It was a reminder of the strategy that built Berkshire: buy what you understand, at a fair price. Quietly, Buffett kept creating value, one sensible deal at a time. With Buffett stepping down, leadership passed to Greg Abel, his long-designated successor. Abel, a key architect of Berkshire Hathaway Energy, is no newcomer. He built the energy division into a global powerhouse, mastering capital-intensive investments. Abel's style differs from Buffett's. He's a detail-oriented operator with deep business knowledge. His hands-on experience and credibility make him a natural fit. Abel learned the Berkshire way directly from Buffett, embodying its culture of integrity and long-term thinking. He's not expected to be a Buffett clone, but to apply Berkshire's principles in his own way. The transition signals continuity, stability, and a focus on operational excellence. Greg Abel now faces Berkshire's biggest challenge: what to do with $381.6 billion in cash. Shareholders and markets expect action. Growth depends on smart investments. Letting cash sit idle isn't sustainable, but finding big, quality deals is harder than ever. Abel may need to pursue a series of mid-sized deals or boost stock market investments through Berkshire's other top investors. Unlike Buffett, Abel doesn't yet have the same legendary patience in the eyes of shareholders. He'll face pressure to act, but must avoid suboptimal deals just to show progress. His experience in deploying capital in energy will be crucial. The challenge is immense, but so is the opportunity. If Abel invests wisely, he'll secure his own legacy and keep Berkshire's wealth engine running. The future depends on balancing patience with bold, rational action. Buffett's final year as CEO was a masterclass in patience and discipline. He showed that sometimes the wisest move is to wait, not act. His decisions to trim Apple and Bank of America proved that investing is about value, not loyalty. Selling when prices are high is as important as buying when they're low. The seamless transition to Greg Abel was years in the making, ensuring stability and continuity. Unlike chaotic leadership changes elsewhere, Berkshire's handover was deliberate and calm. Buffett's legacy isn't just wealth, but wisdom, discipline, patience, integrity, and lifelong learning. As Berkshire enters a new era, it does so on these timeless foundations. The final chapter wasn't about a spectacular deal, but about reinforcing enduring values. Those values will guide Berkshire Hathaway far into the future.